Okay, for this video, I wanted to go over Form 7203, which is the S Corporation stock and basis form that is now being included with Form 1040s, right? So the form, it's only been out about 2 years, and what this is designed to do is adequately track your stock and debt basis in an S corporation to determine whether or not you can actually deduct the losses on your 1040. So I've got one slide in front of us here with some of the basic rules, the fact pattern that we're going to be working with. And then, of course, I have a sample 7203, right? So we've got a 7203 here with a return, so a 1040 for John Smith. So we'll look at the return, we'll look at the 7203. And then we've got John's K1 from the S Corp as well, right? So he's got an S Corporation. He's a 50% owner in this S Corp that has some losses, and we're going to see how all this information gets entered on his return, and then ultimately how the basis limitation form works to kind of cap the amount of losses that he can deduct in the current period. All right, so if we start with the slide first, go over some of the basic details here. So the 7203 is a new form, but adequately tracking your stock and debt basis has really always been required. You just never had to submit any of the worksheets or a form with your return to the IRS, but you still had to track all of this separately and effectively keep it for your own records. So the form is now being required under really 4 circumstances. So on your 1040, you're going to be claiming a deduction for aggregate losses, or you received a non-dividend distribution from the S Corp. You sold your stock in an S Corp, so that could be a partial or a total disposition. And it's still required even if you didn't sell for any gain, right? You still have to report all this information on the 7203. And then lastly, if you as the shareholder, you received a loan repayment from the S Corp. So that would happen if you loaned the S Corporation money. So that was your debt basis in the company, and they repaid some of that debt. Now, note here, our recommendation is always to file this. I always try to adequately track the stock and debt basis for shareholders, even if they're profitable, right? And because it's always good information to know what your bases are in these various items, because if you go to sell the stock at a later date, well, you're going to want to know, well, what is my real stock and debt basis in the company, because that's going to impact my gain. It's not just a matter of can I deduct the losses or not. Now, the basis worksheets for Form 1120S, they are not a required schedule, but most tax prep software will generate these for us, and we try to prepare them and review them as well just to make sure they are accurate. But they're not required in that the IRS wants you to include them with the return. So the general rule here for basis limitations is, your deduction for losses is going to be limited to your positive basis in the stock, right? That's your stock basis and your loans to the S Corp. To the extent you have any losses that exceed those amounts, well, those are carried forward to future years. And then maybe in a future year, you'll be able to deduct those if you contribute, additional capital to catch up your basis, or the company is more profitable, right? A lot of things could happen that'll allow you to take those losses in the future. So here's the fact pattern we've got, right? We've got John, he's a 50% owner in an S Corp, and he materially participates in the business, so this is going to be a non-passive activity for him. Now, when he got started in the company, he contributed $10,000 of cash in exchange for 50% of the stock. And during 2022, there were no dividend distributions during the year. Okay, so only money in for John at this point. Now, John is also working part-time as a marketing consultant, so he has a separate job. And he got a W-2 from that employer showing total wages of $40,000 and income tax withheld of $4,000. Now, John is looking at this and thinking, well, I'm being allocated K1 losses of $27,015. Can I use any of these losses to offset my W-2 wages, right? So if we look at John's K1 here, we can see his K1, he's got a 50% interest. And his line 1 losses are $27,015. He's got some interest and dividend income allocated here, some tax credits related to the work opportunity credit. But this is the big ticket item, right? 27,000 in losses. Can I use any of that to offset my other active income, my other non-passive income? And so, apart from assuming there are no limitations here under the passive activity loss rules, the one question will be, well, do you have enough basis in the stock to even deduct that amount, right? And so, if we look at John's 1120S K1 here first, notice a couple things, right? So he's got the losses. Remember, he put in $10,000 in cash. And so this K1 package includes a basis worksheet. So the shareholder basis worksheet prepared from the S Corp records, right? So this is done as part of the S Corp return. But as it notes here, your basis is reported on the 7203 and is determined at the shareholder level, right? And so that's really important because the basis worksheet prepared by your S Corp might not necessarily match with your actual basis in the stock, right? And what you would report on your 1040. But in this case, they will match because everything is relatively straightforward. So when we look at basis, we're looking at a couple of things here. So basis is increased by capital contributions made to the company. It's increased by positive allocations of income. So we have the interest and dividends. And then it's reduced by non-deductible expenses first, right? So we see decrease for non-deductible expenses and then decreases for ordinary loss items. Now in this worksheet, notice what's happening here. We're adding up all the positive increases to the basis. We're deducting it by the line 16C item. That's the non-deductible expense of $1,440. So this is his adjusted basis before accounting for any of these ordinary loss items. So $8,585 is his basis going into the loss deduction. And we can see here that this worksheet, even though he's being allocated $27,000 of losses, he's only being allowed to take $8,585 because this is where his basis is capped at, right? He doesn't have any more basis in this, right? And so we can see down here, if he takes this entire loss amount, his ending basis is going to be the stock basis up here on line 11, it's just going to be 0, and then there's no debt basis, right? And then a nice little carryover reconciliation here shows us that, well, of all the losses and deductions, the $28,455, he's going to be able to apply $10,025 because those were the positive amounts to his basis. And then the end of the year carryover is going to be $18,430, and that's all going to be ordinary loss carryover. All right, so now that we've covered kind of how the basis worksheet would look from the K1 package, let's see how it actually impacts his tax return. So the 7203 here, top of the schedule, we have the name of the shareholder, the name of the S corporation, and then it is asking us for the stock block. So what do they mean by that? Well, for every time you acquire stock in the S corp, or you inherit a piece, or you're gifted a piece, those are referred to as separate blocks, and you have to separately track your basis in each block because they might very well be different. And so you could actually find yourself filing multiple Form 7203 to track your separate blocks of stock in the S corp. So the naming here is really kind of moot. It doesn't matter so much from the IRS perspective, but you should be tracking your blocks from your own records and make sure that, well, when you have a 7203 for block 1, let's say, you're consistently using that for block 1. And then if John was inherited stock, let's say from his other business partner, well, that would be block 2 to him, right? It'd be from his perspective. So we've got original shareholder here, right? Because John was one of the founding members of the company. So the initial stock issuance, he received 50% of that initial stock issuance, so he is the original shareholder here, right? He did not purchase it from an existing shareholder, nor did he inherit it or was gifted it. All right, so the stock basis worksheet, a couple of parts, right? Part 1 is the shareholder stock basis. Part 2 covers debt basis. You'll notice here there are no entries because in our fact pattern, John's only contributed capital. He hasn't put any debt into the company. And then Part 3 is a reconciliation of the allowable losses and deductions for the year. So the flow of the form very much mimics what we saw on the shareholder basis worksheet as part of the K1 package, right? So the stock basis at the start of the year is 0. His basis from capital contributions made during the year is $10,000. And then we have the positive amounts of income being allocated. So $5 in interest, $20 in dividends. And so his basis before any kind of dividends or non-deductible items is $10,025. Now, the non-deductible items come in first, right? So that reduces his basis down to $85.85. That's his new or adjusted stock basis before factoring into what is the allowable loss and deduction. So once you have your line 10 amount there, you then have to look at section part 3 to figure out what's going to be the allowable amount. So part 3, column A, are just the current year losses and deductions. Column B would be if there's any carryover amounts from the previous year. So because this is a first year, we don't have any carryover amounts. But if we're doing the 2023 form for John, what we'll see is there will be column B amounts, right? Because he's going to have carryover amounts from this year that he cannot use. So when you look at the aggregate of column A and column B, if these amounts are greater than the stock basis reported here on line 10, then you take the line 10 amount and you allocate it in column C across all the items that you might have here. Now, because we only have one line item here, right, line 35, all of the 85 in stock basis is just allocated to line 1. But if you had losses or deductions, let's say you had some charitable contribution deductions, maybe some interest, investment interest expense, you can allocate these pro rata depending on the amounts here. But again, we just have the one line item, so all 85 is allocated here, and that'll be the loss allowable from the stock limitation, and then that is the carryover amount, the difference, right? Remember, and notice all these match what we had on our worksheet as our K1 package. So once you've got the allowable losses and deduction items coming up from line 47, column C, all of this nets down to 0, so the stock basis at the end of the year is 0. All right, so now once we have all this done, how does this actually look on the tax return? Well, if I jump up here to page 1 of the 1040, we can see we've got John's W-2 wages there for $40,000. We've got his investment income down here. And if we look at the Schedule E Part 2, let's start there. So Schedule E Part 2, this is where we report our income or loss from the partnerships or S Corps. So we have our fake lawn care business here. It's an S Corp, and we are indicating in box E that a basis computation is required, and that's because we are deducting losses, right, against our stock basis, and we have carryover amounts, right? So the non-passive loss allowed, remember, even though he had 27,000 some odd in losses, the amount that is being allowed in the current period because of the basis limitation is $8,585. So this is the amount of the loss that ultimately flows up here, right? If we look at Schedule 1 up here, the additional income and adjustments. Line 5, we have our amounts flowing through from rental real estate, partnerships, or S Corps. There's the 85 in loss, because again, that's the basis limitation. And then ultimately that loss is carried forward to page 1. And so he does get to offset his wages and these income items up here with the 8,585 in losses. All right, so if we revisit the fact pattern, again, the question John had was, all right, I've got all these flow-through losses. It's a non-passive activity. Yeah, you can deduct a portion of them. However, it's going to be limited to your stock and debt basis. Now, everything else that doesn't get to be utilized in the current period is just carried over to the next year. And so that's what John has to remember when he does his return for the following year, is that, hey, looking at Part 3, I've got some carryover amounts here. So if we're looking at the 2023 7203 for John, this $18,430 is going to show up here in column B, right? So it's a ordinary business loss reported here as a carryover amount from the previous year, and then whatever happens in 2023 for John, right? If he has another loss year with some more deductions, then we might see some items in column A. All right, so that covers it for this fact pattern. Hope that was helpful. If you have any questions, feel free to leave me a comment below, and I look forward to seeing you again on the next series. Thank you.